Welcome back, everybody. We're going to discuss Chapter 23, which is closing the real estate transaction. Closing the transaction is a very important part of a real estate professional's activities, and so we're going to talk about that in detail. The closing of the transaction is the time when the title to the real estate is transferred in exchange for the payment of the purchase price. A real estate transaction, a sales transaction, is a bilateral transaction. The seller agrees to convey title, the buyer agrees to give money in exchange for the title, and the closing marks the end of the transaction. All of the licensee's efforts are driven towards this goal, and it's also something that's very complicated. And the licensee is at the closing mostly for the support of their clients, and as you begin the transaction with them, it's a very important aspect of it to make sure you're closing out the transaction with them as well, because we initiate an uninterrupted chain of events that results in the sale. And so you're with them in the beginning, and you should be with them in the end. Many refer to the process prior to the closing as a pre-closing procedure. And the closing marks the end of the real estate transaction, and at closing, an executory contract becomes a fully executed contract. The promises that were made in the sales contract are fulfilled. The mortgage funds are distributed, and the buyer receives the keys and the deed at the closing. Of course, there are issues for both the buyer and the seller in the closing of the transaction. There's things that they both would be concerned about. The buyer wants to ensure that the seller delivers good title and fulfills all of the conditions of the contract. The buyer wants to make sure they do a final inspection of the property to make sure that the property is in the same condition it was when they made their property offer. The seller has issues as well. The main interest is that they make sure that there's adequate documentation so that the closing can come forward and that they can get paid the monies that were promised in the sales contract. Many transactions will require a survey. A survey set out all of the existing easements and encroachments that the property might be subject to, and most lenders, when there's a finance transaction, will require at minimum a spot survey that's dated no more than 6 months prior to the closing. The title procedures there are two ways that companies might close on the transaction. There's face-to-face closing, and then there's closing in escrow. But the title procedures, whereby the buyer or the buyer's lender, they want to make sure that there's an assurance that the seller's title complies with the requirements of the sales contract, and for that reason, there's two policies that are issued. The seller is required to produce a current abstract of title or a title commitment from a title insurance company guaranteeing to the buyer that they have good title. That means it's free and clear of anything that might impact the buyer. The buyer also would require that there be the production of the same guarantee that would be issued or given to the mortgage company that there's going to be good title. So generally, there's two policies that are issued at closing. There's the owner's policy that's issued that protects the owner for up to the sales price, and there's the lender's policy that would protect the lender up to the loan amount. The abstract of title is a summary of all of the matters relating to the history of the property. And when an abstract of title is used, the purchaser attorney will examine it and issue an attorney's opinion of title. So an abstract is a summary. In the text, it mentions a title search. Well, a title search is all of the information related to the property. An abstract of title is a summary of all of that information. And the buyer's attorney is going to look at that and going to give what they call an attorney's opinion of title, basically a statement saying whether or not he believes that this is good, free, and clear title. There are usually two searches of the public record. The first would show the status of the seller's title on the date of the search or a few days before closing, and then the second search is made after the closing. The search is referred to as either a bring down or a later date search. And an affidavit of title is signed by the seller at closing, guaranteeing that in between they have not done anything to cloud the title. So from the sales contract to closing, The affidavit of title is a statement by the seller that says basically between the sales contract or the initial title, preliminary title, and the closing that the seller has not done anything to create additional liens on the property. And the title can be, and the title company can sue the seller in the event that there's a cloud that arises whereby the title company has to pay to settle a claim. Good funds requirement, $50,000 or more. Well, back in 2010, the Title Insurance Act was amended to prohibit title insurance companies, title agents, or independent escrowees from making disbursements at closing when the amounts held for disbursement include funds from any single party in excess of $50,000 out of fiduciary trust account in connection with the escrow, settlement, or closing, unless the funds are collected are good funds, usually from a wire transfer and not from, say, a personal checking account. Good funds requirement less than $50,000. Well, if it's a personal check, it cannot exceed $5,000, or cash monies up to $49,000, or a cashier's check or certified funds drawn on the state or U.S. chartered financial institution. Now, monies coming from the brokerage need not be wire transferred. And so we're talking about earnest funds and things like that. Conducting the closing. Well, in Illinois, the closing statement is customarily prepared by the buyer's lender, the lender's agent, and which is usually a title company, or the seller's attorney will draft the closing statement. And a real estate licensee, that means the broker, managing broker, or leasing agents, are prohibited by the Illinois Supreme Court decision, the Chicago Bar Association versus Quinlan and Tyson, from completing closing statements. We cannot create or put together closing statements if you're a real estate professional. Estimate statements are often needed if we're preparing a CMA to give the seller an idea of how much they might walk away with respect to their net. And we also may include a statement with a buyer so that they can know possibly an approximate amount that they might need to bring to closing. But these statements are not used as the final statements, right? These are just preliminary or statements used to give additional information to the buyer or the seller prior to the closing. But the actual closing statements will be prepared by a lawyer, the seller's lawyer, a title agent for the transaction would prepare those statements. For this purpose, licensees must understand the preparation of the closing statement, which includes expenses and proration of costs incurred by the participants in the transaction. So we need to be well abreast of how these things are put together, because we may give estimates when we put together our CMA. But the Illinois licensing examination for broker candidates includes specific questions regarding closing statement calculations. So you definitely want to make sure you're well abreast of that and how to do it. In Illinois, we conduct what are called face-to-face closings. That means the buyer and the seller will meet together on the final day of the, we'll meet together based on an agreement, which is a contract, and that's where they're going to fulfill their promises that are made in the sales contract. The buyer's loan would be finalized, and the mortgage lender would disperse the loan funds during a single meeting of all the parties and their attorneys. The closing agent or the closing officer is how the person is usually referred to. It's one person that's employed by a title company, and they conduct the proceedings at the closing. They calculate the divisions of income and the expenses between the parties, and they are an employee acting as an escrow agent for the buyer's lender during the time of the closing. They are a neutral third party between the buyer and the seller, and again, they are an agent of the buyer's lender, and they're going to follow the buyer's lender's instructions as they go through the closing procedures. The exchange. Well, the exchange is when the parties are satisfied. The exchange of money for the deed is made. For a deed to be valid in the state of Illinois, there must be what's called delivery and acceptance. Now, another process to close a transaction is closing an escrow. We don't close an escrow in Illinois, but there are many states that have escrow closing procedures. It's a method of handling the real estate transaction in which a disinterested third party is authorized to act as an escrow agent for both the buyer and the seller and to coordinate all of the closing activities. The escrow procedures, the way that they are performed, so the buyer and the seller would both execute escrow instructions and submit those escrow instructions to the escrow agent immediately after the sales contract is signed. The licensee that's involved in the transaction would turn over the earnest money to the escrow agent, who would then deposit it into a special trust account or escrow account. When all of the conditions of the buyer and all of the conditions of the seller are met and all of the liens are paid, then the agent would disperse the purchase price to the seller and record the deed and mortgage or the deed of trust for the buyer. Closing of real estate transactions require IRS reporting and must meet the IRS reporting requirements. The closing agent or other representatives of the seller must report every real estate transaction on an IRS Form 1099-S, which is supplemental income. The broker's role at closing is one more of public relations than anything else. Usually, again, you started the transaction with the consumer, and you're going to close out the transaction with this client. And usually, public relations role is what you're going to play at the closing. The licensee is the individual the clients have known and been in contact with throughout the transaction. And many times the closing is the first time that they might meet their attorney, but they've been engaged in a continued ongoing relationship with the agent, and the agent should be there just to help them through the final stages of the transaction. The lender's role at closing is a little bit different. The lender wants to make sure that they protect their interests in the property. They want to make sure their lien is recorded on the property. They want to make sure that the escrow or impound created for insurance and for insurance and taxes are paid. And it's very important. Lenders want to make sure that the taxes and the insurance are paid, so they want to make sure there's proper funds in the escrow account at the closing, so when those bills are due, the payments can be made. And the Mortgage Disclosure Improvement Act states that the timing of certain disclosures now affect the date of closing. And it's really critical that all proper disclosures be made to prevent any improper disclosure and potential liability to the real estate licensee or the company. RESPA. RESPA are federal laws. It's the Real Estate Settlement and Procedure Act. It's a body of federal laws that were enacted to ensure that consumers be provided with important, accurate, and timely information about the actual costs of closing or settling a real estate transaction. It also serves as a mechanism to prevent kickbacks and other situations where people may inflate the cost of settlement unnecessarily. And RESPA prohibits kickbacks and unearned referral fees. Unearned fees, I should say. When does RESPA apply? Well, RESPA applies when the purchase is financed by a federally related mortgage loan. A federally related mortgage loan is any loan that's made by a bank, a savings and loan association, or any other lender whose deposits are insured by the federal government, FDIC insured. Loans that would be sold in the secondary market are governed by RESPA. RESPA also applies to any first lien residential mortgage loan that's made to finance the purchase of a 1 to 4 unit family home, and second or subordinate liens for home equity loans. So basically, when you first buy a house and it's 1 to 4 units, RESPA applies. If you refinance that original loan with a new loan, RESPA applies. If you were to get a HELOC or a home equity line of credit, RESPA applies to those transactions as well. Loans on large properties, 25 or more acres, are exempt from RESPA. Loans for business or agricultural purposes are exempt from RESPA. Construction and temporary financing loans are exempt from RESPA. Vacant land, unless the dwelling will be placed on it within 2 years, is exempt from RESPA. Any transaction financed solely by purchase money mortgage taken back by the seller, RESPA is exempt from RESPA. So if it's owner financing, it's exempt from RESPA. If there's an installment contract or a contract for deed or a land contract, it's exempt from RESPA. Or if the buyer is assuming the seller's existing loan, it would be exempt from RESPA as long as the terms of the loan that are assumed do not charge more than $50 for an assumption fee. So if it's less than $50 assumption fee, RESPA doesn't apply. If it's more than $50 assumption fee, RESPA does apply. The disclosure requirements under RESPA. Well, lenders must provide a copy of a special informational booklet at the time of the loan application or within 3 days afterwards. RESPA requires that the real estate settlement statement be completed at closing to itemize all of the charges that are paid for by the buyer and the seller. Basically, the buyer and the seller should know the full cost of settlement, and it's going to go on a standardized document that's required by federal law. As I had mentioned earlier, RESPA prohibits kickbacks and referral fees. RESPA strictly prohibits the payment of any kickbacks or any unearned fees in any real estate transaction or settlement service. And RESPA requires a disclosure when there's a controlled business arrangement. Brokers and brokerage companies, I should say, are oftentimes involved in collateral business activities like title companies or mortgage companies or inspection companies. And it's very possible that the real estate company may own additional businesses that might be involved in a transaction. Well, if a consumer is clearly informed of the relationship and instructed that other providers are available, brokers may offer these services, but fees may not be exchanged among the affiliated companies simply for referring business from one company to another. There's a new rule that was passed back in October of 2015. It's called the TRIG. TRIG stands for the TILA-RESPA Integrated Disclosure Rule. It's a new rule that requires individuals to know certain information before they owe money to the mortgage company. They refer to as the know before you owe mortgage disclosure is what it's referred to. And it replaced previous disclosures that were required. Basically, what TILA did, TRIG, what TRIG did was it took the former document called a good faith estimate and the former document called a truth in lending statement. It basically smashed those two documents together, and the new document is called a loan estimate form. So the loan estimate form replaces the truth in lending statement and the good faith statement that formerly was required. And RESPA also requires what's called a closing disclosure form. The closing disclosure form replaces what used to be referred to as the HUD-1 settlement statement, and these have been effective since October 3rd of 2015. The loan estimate form, it's a great document. As I had mentioned, it's a combination of the good faith estimate and the truth in lending statement smashed together in a document that makes it a little bit easier for the consumer to understand the costs that they're going to face. The loan estimate highlights the information that has been most important to consumers historically. Things like the interest rate, the monthly payment, the total closing costs are clearly presented on the first page of the loan estimate form. And the form must be provided to the consumer within 3 days of a mortgage loan application being submitted to a lender in the United States. Copies of the form can be found at the various links that we have included in your documentation. A complete sample of the form can be found in another link that we also included in your documentation as well. The next form that you guys have to be familiar with is the closing disclosure form. This is given to a borrower and to the seller. The closing disclosure form provides very important information about the cost of taxes, insurance, and how the interest rate and payments may change in the future. It warns the consumer about things they may want to avoid, such as prepayment penalties. And the form must be provided to the consumer within 3 days of the loan closing. If the person does not receive this within 3 days, then the closing will not occur. Or if things change substantially between this document and the closing may not occur. A complete sample can be found at the links that have been provided to you in our documentation. And for more information and updates, you can go to the Consumer Financial Protection Bureau's website and get more additional information regarding these rules. Now, preparation of the closing statement is really important that we understand how things are prorated. There are things that are considered to be debits, and there are things that are considered to be credits. And a debit is a charge against a party. That means you have to pay when you have a debit. A credit is an amount that's going to be given to a party. It means you're going to receive a credit. So you pay a debit, you receive a credit. And the debits and credits must balance out. They must be equal. All right, so if it's a debit to one party, it's going to be a credit to the other party. A credit to one party is a debit to the other party because they must balance out. Calculating a buyer's cash to close, well, the buyer's debits are totaled with the major items being purchased, being the purchase price. The purchase price is a huge debit. If you agreed to buy a house for $100,000, that means you need to bring $100,000. That's a $100,000 debit. Any expenses and prorated amounts for the seller's prepaid items are going to be added to the purchase price. And so if the seller in a condominium prepaid for the full years of assessment, well, if they paid for the full years of assessment and we sell the property in June, well, they should be credited with the assessment that they're not going to use because they're selling the property. So a seller's expense that's been prepaid will be reflected as a credit to the seller and a debit to the buyer. The buyer's credits include the earnest money. Since they've already deposited the earnest money, they're going to receive a credit for what they've deposited previously at the closing. And so they're going to receive that credit at the closing. And then finally, the total of the buyer's credits are subtracted from the total number of buyer's debits, and the balance is what the buyer would need to come to close the transaction. Now, calculating the amount to be received by the seller. Well, the seller's credits are going to be all added up, everything, including the purchase price, which is the biggest credit. And they're going to deduct from those credits all of the debits that the seller may have to be responsible for, like paying off an existing mortgage or paying real estate taxes or assessments or any fees that the seller might have incurred are going to be reflected as debits. The purchase price is a credit. Everything would be debited from that. The balance is what the seller would net. Your commission would be reflected as a debit to the seller. The broker's commission is determined by a previous agreement. A listing agreement is generally what's going to be used to determine what the amount of the agreed commission might be. And the listing commission or the commission for the real estate company is going to be charged to the parties at closing. In many circumstances, the seller has agreed to allow the broker to retain the earnest money as a part of or the full amount of the commission. Attorney's fees. Well, both parties may have attorneys involved in the transaction. And if either of the parties' attorneys are going to be paid from the closing proceeds, well, the party will be charged the expense in the closing statement. It would be reflected as a debit, and it would have a line item that states that it's an attorney's fee. Recording expenses. Well, the seller usually pays for the recording charges that are necessary to furnish the purchaser with a marketable title, including the recording and release of an existing mortgage. The buyer or purchaser is usually going to pay for the recording fees that are charges that arise for the transfer of the title. They're going to pay, the buyer is going to pay for in most transactions, let me say. In most transactions, the buyer is going to pay for the recording of the deed that conveys title from the seller to the buyer. They're also going to pay for the fees that are incurred to record the mortgage or the deed of trust that's used to finance the property or used as collateral when there's a loan used to finance the property. Now, there's what's called a transfer tax. When you transfer a property from one party to another, that transfer is going to incur a tax. And in Illinois, the seller is required to pay the state and the county transfer tax. Seller, in accordance with most sales contracts and state law, usually pays the county and state transfer tax, but it is something that could be negotiated and paid by the buyer. Local ordinances establish which party is responsible for paying municipal transfer taxes. Cities and villages sometimes also have transfer taxes, and there may be a tax for both the buyer and the seller, and it's going to be established by the local ordinance. Title expenses. In Illinois, there are two policies that are usually issued at closing if the transaction has a financing component. One would insure the buyer for an amount up to the purchase price, and the other policy would cover the lender for up to the loan amount. Customarily, the seller will pay for the buyer's owner's policy, and the buyer will pay for their lender's policy. Loan fees. Well, loan fees, generally, the lender is going to charge what's called a loan origination fee in some transactions, but they also may charge what are called discount points. And they also may have other charges related to the issuance of a loan in conjunction with the transaction that would be charged to the buyer at closing. Now, many lenders will require the buyer to have an account set up for the collection of taxes and the collection of insurance money to be paid when the bills come due. We refer to those as an escrow account. It's sometimes referred to as an impound account or a trust account. Most lenders require that the borrower or buyer provide reserve funds or escrow accounts to pay for future real estate and insurance premiums, and the borrower is responsible for maintaining adequate fire and hazardous insurance and the payment of taxes. Appraisal fees are included in the transaction's closing as well. On the settlement statement, it would reflect the appraisal and the fee that is incurred for the appraisal, which is usually paid for by the buyer. Ordinarily, the lender requires an appraisal and the cost will be charged to the buyer as a debit. But oftentimes, the buyer has prepaid for the appraisal at the time that it's performed, and so it would reflect POC. And POC on the settlement statement stands for paid outside of closing. If the buyer paid the appraiser when they appeared at the property to perform the appraisal, that's paid outside of closing. But it could be, the appraisal could be performed and it could be paid for at the time of closing, and it would be a debit to the buyer. Survey fees. Well, in Illinois, most real estate contracts require the seller to furnish the buyer a survey that's dated within 6 months of the closing of the transaction. And expenses of preparing the survey is usually borne by the seller, but it is something that could be negotiated in the sales contract. If the buyer's lender requires a survey, it is very possible that the buyer might be required to pay for that survey that's required by their lender. And so you have to read the sales contract to make sure that you're clear about who might have the liability of paying for the survey. Additional fees in the real estate transaction, if it's a loan that's a FHA loan, where there could be a lump sum payment for mortgage insurance premium. If the loan is not financed if it is not financed as a part of the loan, there may be an upfront lump sum payment for the mortgage insurance premium. And if it's a VA loan, there could be the payment of a funding fee that's paid directly to the VA at the closing, and that will be charged to the buyer that's using VA financing. And in a conventional loan transaction, if the loan carries private mortgage insurance, the buyer will, in many cases, prepay 1 year's insurance premium at the closing. As far as the accounting for expenses in the real estate transaction, expenses that are paid out of closing proceeds are charged to the person who's responsible for the payment of that expense or debt. And occasionally an item or an expense item may be shared between the parties, but again, that's something that would be negotiated in the sales contract. Prorations are when the parties are going to pay the expenses and the expenses are going to be distributed and divided fairly between the buyer and the seller. Remember, prorations, both sides must be equal. So if there's an amount that's debited by one party, it must be accredited at the exact amount to the other party. An amount that's debited by if it's a buyer debit, it has to have an equal amount that's a credit to the seller. If it's a seller debit, there has to be an equal amount that's credited to the buyer. Debits and credits must equal. Accrued items. Well, an accrued item is an expense that's owed by the seller, but will be paid by the buyer after closing. And so in Illinois, real estate taxes are paid in arrears. That means that in 2016, we're going to pay 2015's real estate taxes. In 2017, we're going to pay 2016's real estate taxes. Well, if I'm the seller and I sell the property in 2016, well, the tax bill is not going to be due until 2017. So I must give the money to the buyer that I owe in order for the buyer to have the full amount necessary to pay the bill. And so expenses that are owed by the seller but will not be paid until after the closing, well, those are going to reflect as a debit to the seller. The seller has to pay, the seller pays by giving the buyer a credit, which means that the seller will have a debit at the closing. And so this would reduce the amount of money that the buyer would have to bring to closing. And the seller will be charged for his share in the form of a debit and a credit to the buyer. All right. So accrued items are going to be a buyer credit and a seller debit. Prepaid items will reflect as a seller credit and as a buyer debit. If a seller paid the water bill for the full year and they're going to sell it in June, well, they should get a credit of some of that money back because they didn't have the property for the full year. So a prepaid item would reflect as a credit to the seller, debit to the buyer. Expenses that have been prepaid by the seller but are not fully used up by the seller, well, they're going to get a credit back for the unused portion. And that's going to be credited to the seller. This is money given back to the seller and a debit that's charged to the buyer. With respect to the arithmetic of proration, well, computation of the proration involves identifying the yearly charge for the item and then dividing the yearly charge by 12 to determine what the monthly charge is. Reducing it, and then we're going to further reduce the monthly charge to a daily charge by dividing it by the number of days in the month. And generally, we're going to use the statutory method where we assume that each month has 30 days. And we're going to get what's called the per diem, or the daily amount. And then we're going to multiply that number by the number of days in the prorated time period to determine the actual accrued or earned amount. And the formula that we use is basically the yearly charge divided by 12, and then we divide that by the number of days in the month, and then multiply that by the number of days of the credit or the debit during the month of closing. We use either the statutory method or the actual number of days method. The statutory method, as I just recently mentioned, is where we're going to assume that each month has 30 days. So that means we're going to use a 360-day calendar where we have 12 months, 30 days in each month, which gives us a total number of days of 360. The alternative method is the actual number of days method, where the yearly charge is divided by 365 days or 366 days during leap year to determine what the daily charge is. The actual number of days in the proration period is determined, and this number is multiplied by the per diem or daily charge. In Illinois, we have a third method, of course, and it's a variation of both of the two that I just discussed. It's called the statutory month variation, and it's also acceptable for inexpensive residential properties. Attorneys for the parties usually determine an actual number of days method. If the statutory month variation is used, the yearly charge is divided by 12 to determine what the monthly amount is, and the monthly charge is then divided by the actual number of days in the month in which the closing occurs, and this final number is the daily charge for that month. As a memory tip on the exam, if you are not told how to prorate the figures, the statutory or actual use of the statutory method is what we would recommend. If the question does not ask for the actual number of days or the statutory method, use the statutory method, all right? And the general rule of prorating, rules or customs governing the computation and proration of the closing of a real estate transaction, they vary from state to state, but most states, the seller owns the property the day of closing, and so we're going to include the day of closing on the seller's side of the balance sheet. Prorations and apportionments are made to and including the day of closing, and those are all on the seller's side. The buyer owns the property the day after closing, and we'll use that as a means to determine the buyer's side of the transaction. All expenses are charged against the seller, but all revenue is credited to the seller for the closing date. Mortgage interest, general real estate taxes, water taxes, insurance premiums, and similar expenses are usually computed using the 360 days in the year, which is referred to as the statutory method. Accrued and prepaid general real estate taxes are usually prorated at the closing. Now, in some situations, there may be special assessments and rents and prepayment of condo assessments. Well, a special assessment for municipal improvements, the seller normally pays the current installment and the buyer would assume all future installments. With respect to rents, rents usually are adjusted on the basis of the actual number of days in the month of closing, and the seller generally transfers the security deposit to the buyer at the closing. If there's a condo transaction, the prepaid condo assessment, well, if the seller prepays the condo assessment, well, the buyer is going to have to give them some of their money back. So the buyer will be charged for their share of the assessment from the day after closing until the end of the month, and the seller will receive a credit for that amount. Because again, if it's a debit to one party, it's got to be a credit to the other party. In Illinois, specifically, taxes are paid in the year after they become a lien. If there is an unpaid installment that has been billed, this actual amount is credited to the buyer and debited to the seller. The buyer must be credited with the current year's taxes, and the seller would be debited accordingly so that the buyer has the necessary funds to pay the bill when the bill is issued. Proration from January 1st up to and including the day of closing is what we would use in determining the prorated amount that would be a credit to the buyer and debit to the seller. This concludes Chapter 23 and the closing of the transaction. Wish you guys well and good luck on the exam.